Hello, everybody, and welcome to IIE Financial's Education Series. Today, we are going to talk about stock market indexes. Why do they exist? What are they? And how can an investor use them? As we go through this lesson, one of the things that we want to be mindful of is what are stocks, right? A stock is essentially it's a share of ownership in a company, right? It is ownership in a company, and it's a fractional amount of ownership. And the more shares that you have, the bigger percentage of ownership you have in the underlying company. Well, one company does not explain what the whole market is doing. And what the index is a measurement of market activity. So what we're going to do today is going to talk a little bit about why are we here. We're going to cover the major U.S. stock market indexes and then why they are used. So, we are here primarily because as a stock market index, the thing that we are concerned with, it's a way to measure market activity. But the items in that index are an important distinction because different indices will have different items that are included in its calculation. And the different things that are included in its calculation will help to change the way that it's formulated. So in the U.S. markets, we have three major indexes that we're going to pay attention to. Now, there are more indexes, and there are indices really all over the world for the different markets that are literally all over the world, from the DAX in Germany to the FTSE in the UK to the SPI, the Singapore index. But the ones that we look at primarily in the U.S. are the Dow Jones, the Nasdaq, and the S&P 500. We're going to look at these three today and really kind of talk about what makes each one of those different, and most importantly, why do investors find it a good tool and something that they want to use? So let's start with the Dow Jones. Now, the Dow Jones, there are Dow Jones Industrial Averages. There's the Dow Jones Transportation Average. There's a number of different averages in the Dow Jones, and the Dow Jones started in the late 1800s, but it's been 30 stocks since 1928. And starting in 1928, we started to measure those 30 stocks. Now, it was originally created as a way to track market movement when information was limited. If you think back to when the Dow Jones was first created and when it was first popularized, it's not like people could just go on the internet or just pick up a newspaper and see what the entire economy and the entire world was doing. It was a little bit harder to get information. So what the Dow Jones allowed investors to do was very quickly get a snapshot of the U.S. economy and the U.S. stock market. The U.S. stock market has been around since 1792, and it didn't have truly an index to measure its performance until the late 1800s. And then that index expanded in 1928 to include 30 stocks. Now, interestingly enough, the Dow Jones is what's called a price-weighted index. So as prices of the underlying securities that are in that index go up, it's going to change the way the Dow is measured. And the measurement of the stocks in that index will also change based on what is in the index, because companies will get moved in and out of the index. Matter of fact, since 1928, the components have changed 51 times, because when a stock starts to fall out of favor, it's oftentimes going to wind up being replaced. Some very recent additions to the Dow Jones were companies like Apple and Cisco, and companies that came out were companies like General Motors, U.S. Steel, and Alcoa. So if you think about it logically, when the Dow Jones is replacing stocks that are in the index over time, we know that index is going to have to rise, right? There will be ups and downs, but if you're taking out the underperforming stocks and replacing it with some better performing stocks, it's only logic that index over time would always have that bullish bias, and that's really the way the index is designed. And so, as an investor, it's important to realize that when looking at the Dow Jones, the fact that it's only 30 stocks and that it gets changed more frequently than many other items really should make you question the true validity of the Dow to fully measure the U.S. economy's performance. So why do investors love it? Because there are some investors that's the only index that they look at. Well, first of all, it's because it's considered the mega cap companies, right? It's the blue chip. It's not just the blue chip, but it's the mega cap companies. It's the largest of the large. And originally, this was the Dow Jones Industrial Average, where it was companies like Alcoa and U.S. Steel and GE and General Motors and Ford, and the big financial companies that are in there, and it's still the largest of the large companies in the U.S. Now, it's not necessarily the 30 largest companies in the U.S., but it is very, very large companies. And when you think about the prices of large companies, they're going to move slower than a smaller company would. Another reason why people love the Dow is it's a good old slice of Americana. It represents the market's kind of in a classic nature. It's what most people still refer to. When they talk about the Dow, or when they talk about the market, quote unquote, going up 400 points or going down 200 points or going up 30 points, they're normally talking about the Dow Jones. And so when we think about it, it's the more traditional index that people have become accustomed to looking at the numbers. And the other reason is that historically it's always gone up, and we've got because more people have used it for the longest period of time. It's got the biggest memory, if you will, and people just equate the Dow Jones to the stock market overall. Now, the Dow Jones has a lot of traditional stocks in it and things that we're used to seeing. Well, if you look at these indexes, the newest kid on the block is the Nasdaq. Now, the Nasdaq Composite, there's a number of ways we can look at the Nasdaq Composite, and we're going to have to talk about the Nasdaq Composite versus the Nasdaq 100 because people look at both. And both are something slightly different. Now, the Nasdaq Composite is made up of over 2,500 stocks, and it is the Nasdaq stands for, just in case anybody has never heard this, the word Nasdaq is an acronym, and it stands for National Association of Securities Dealers Automated Quotation System. And what that means is that the Nasdaq is an exchange, but it's an exchange that is completely automated and not driven by people at all. And it really, if you think about it, it's for the National Association of Securities Dealers. It's their automated quotation system. So this is a system of computers that are connected together that members of the National Association of Securities Dealers can trade on. Now, as investors, we also can trade on the Nasdaq through our brokers. And when we're dealing with somebody who's going to help us invest in the Nasdaq, why would we look at the Nasdaq? Well, it's what's called a market-weighted index. Now, a market-weighted index is not the price of the underlying security isn't as important as the size of the company, because different companies will have different sizes. We'll look at that in a little bit more detail when we talk about the S&P 500. Now, there's two main industry components that make up the Nasdaq Composite. When we think about the market's broken down into different industries, and there's two components that make up the Nasdaq and why they're used the way they are. But investors love the Nasdaq primarily for its global reaches, the global reaches in the Nasdaq. Now, clearly, most of the companies in there are U.S.-based companies, but there are international companies inside the Nasdaq. And what that does is that gives an investor who's really only interested in investing domestically, it still gives them access to companies that are more foreign. And so now as an investor, you have access to not only the domestic stock market, but also the international stock markets as well. And by being kind of around the globe, what it does is it just increases the diversification of an investor's portfolio by having more companies from around the globe. Now, this is typically going to be when newer investors start to get into the market, they're going to typically go to stocks that are traditionally Nasdaq stocks. Nasdaq stocks are traditionally going to be from the tech sector, from biotech sector, and things that more do-it-yourself investors are typically more interested in. It becomes a much easier market for do-it-yourself younger investors to be involved in. The largest component of that NASDAQ, 45% of the NASDAQ, is actually made up of technology companies. 20% of the NASDAQ is made up of consumer services. So 65% of the NASDAQ is made up in two sectors. Now, the thing to remember about both technology and consumer services is that these stocks tend to move faster than industrial stocks. So a stock like GE is, for a stock like GE to have a 2% move, it's not going to happen as quickly as a stock like Amazon or Apple. The more volatile that a stock is, the better the chances that it's going to move a bit faster. And so the Nasdaq has what's called higher beta stocks. And a higher beta, it talks about the speed at which that stock moves relative to a movement in the S&P. So the higher the beta, the faster that stock will move and the more volatile it will be. Now, beta is the stock's movement relative to the S&P. So let's talk about the S&P. Now, the S&P 500 is also a market-weighted index. Now, it's made up of 500 large-cap stocks. So just right off of the beginning, the Dow Jones is made up of 30, the Nasdaq Composite is made up of 2,500, and the S&P is made up of 500. Well, what are the differences? Well, the thing that we like about looking at the S&P, and what I have here is a picture of what's called a heat map. Now, this heat map was found at finviz.com, and anybody can just go and research and take a look at this heat map. But one of the things that I want you to notice about this heat map is that it's broken up into different sectors. If you look at the black bars, you'll see technology, services, basic materials, financial, consumer goods, healthcare, industrial goods, and utilities. And each one of those black bars represents a sector of the market. Now, let's take a look at one sector. For example, let's look at the technology sector. Now, inside of the technology sector, think of that as one square. You have internet information, telecom services, semiconductors, networking, applications, business software, information. You have all the different sectors that are then broken down again into what are called industry groups. Now, let's use the one that's the easiest to see. Underneath technology sector, in the internet information sector, it's broken down into individual companies. GOOGL, Google, FB, Facebook, YH000, Yahoo, and then 3 other companies. Now notice the size of the boxes. Let's take a look, and we're looking at the upper left-hand corner in the difference between Google and Yahoo. And what you can notice is that Google is a significantly bigger square than Yahoo. Looking to the lower right-hand corner underneath the industrial goods section, you'll see a sector for aerospace/defense. And you see the letters BA. BA is Boeing. Boeing, BA, is right next to GE. Now, looking at this, we can see that the bigger the square, the larger the company. So the largest company in the S&P 500, it doesn't take somebody very long to realize that it's Apple. Apple is the largest stock in the S&P 500. The second largest would be Google. The third largest, as of this recording, seems to be Johnson & Johnson. Now, these size of these boxes will change based upon the market cap. This is measured on the market cap. Market cap stands for market capitalization. So what is the market cap? The market cap is the share price of the stock multiplied times the number of shares outstanding. So as a stock drops in price, its market cap will shrink. As a stock rises in price, its market cap will rise. So a 1% move in Apple has a lot more to affecting the S&P than a 1% move in Ford. A 1% move in Amazon affects the S&P a lot more than a 1% move in McDonald's. And because of this market cap weighted index and the sheer number of the sheer number of stocks that are in this index combined with all of the sectors and the industry groups that are covered, this is a truer representation of the US stock market. This is our truest representation of the performance of the US stock market. And it also, exposes an investor to a little bit less risk, if you will, of an individual company falling apart than, say, the Dow 30, right? The Dow 30, because it's a price-weighted index, is more sensitive to movement of one particular stock. A 4 or 5% move in a stock like McDonald's means a lot more in the Dow Jones than it does in the Nasdaq, than in the S&P. So, as an investor, why do people love the S&P? Well, first of all, they like the S&P because it has so many different sectors, right? Whether you're looking at consumer services, industrials, technology, consumer staples, healthcare, it has all the different sectors and it gives a better view of the overall economy. And the fact that there are 500 companies means that not too much of the index is tied to one company. That's one of the flaws of the Dow Jones, is that a humongous move in one component of the Dow will affect way more than one big move in one component of the S&P. So, as an investor, how do I take a look at the index? Well, as an investor, I can't just go buy an index. An index is not something that can be bought because an index is a measurement. I can't just go buy the Dow Jones. I can't just go buy the S&P because an index is a measurement. That's like buying the weather forecast. I mean, there's no way to really buy it. There's nothing to do there. However, different investment vehicles have been created to allow an investor access to investing in the markets. So let's go take a look at what those are. One of them is to use a mutual fund. Now, a mutual fund it's designed to track the performance of a selected index. So a mutual fund is a basket of stocks that are designed to mirror the performance of an underlying index. Now, in a mutual fund, you can get what are called actively managed funds, or you can get indexed funds. Now, an index fund is a more passive investment strategy. Now, you have to be a suitable investor to invest in this type of a fund because you want to make sure that these funds fit your investment profiles. So, but it's definitely more passive. The idea with an index fund is that you are not moving in and out of it regularly, and the investment manager is not moving the money around in the fund on their own accord. They're following the measurements of the index. Now, one of the benefits of these is that they're typically available in many 401k plans. A 401k plan, and when I say a 401k plan, you could also refer to a 403b or a 457. Many retirement plans, government-sponsored retirement plans, will have an index option available in it. Not all of them do. Check certainly with your plan and with your investment advisor if you've got any specific questions. Now, this is typically a low-cost investment strategy when compared to actively managed funds. So this low-cost investment strategy compared to actively managed funds will allow an investor to get involved. One of the downsides of the mutual fund, however, is that there's no ability for options on these types of positions, and there's no intraday positions. And what we mean by an intraday position is there's no way in the middle of the day for an investor to say, yep, I want to get in right now, or more importantly, yep, I want to get out right now. And so as an investor, mutual funds are what are called forward pricing. And forward pricing means that they're priced at a settlement price at the end of the day. So in an event where we have some sort of very, very volatile market day where an investor wants to get out, if they want to get out in the middle of the day, they're not going to be able to do that. They're going to have to wait until the end of the day, and that is the price that they'll get when their transaction occurs in their position. So one of the downsides of the mutual funds is the inability for those intraday positions. Well, another way that people can trade those mutual funds is to use those indexes is to use ETFs, exchange traded funds. Now, in an exchange traded fund, it's still going to have a lot of the same benefits of a mutual fund. And the benefit of the mutual fund being the diversification and the fact that it mirrors the performance of the index. The ETF will do the same thing. But the advantage of the ETF over the mutual fund is typically lower cost. It trades like a stock. So when we say it trades like a stock, what we mean is that the ETF is traded on the actual index. Now, the makeup of that ETF is still designed to mirror the holdings of the index and the performance of the index. But this delivers the diversification of a fund with the flexibility of a stock, meaning that there's intraday opportunities. And as an investor, it gives you the ability to have a stop loss in place so that if the market takes too big of a move one direction, you can get out of that position, whether it's for a profit or for a small loss. Now, these funds are shortable. Now, certainly they can't be shorted in an IRA because IRAs prohibit shorting. But if you're trading in a regular account, if you're an investor in a regular account, and maybe you want to trade the market to the downside, the ETFs have downside ability. They can be traded long or short. Long meaning that you want the market to go up. Short meaning that you profit when the market goes down. Now, shorting stock is certainly not in everybody's investment profile. You certainly want to speak to your investment advisor to find out if shorting stock might be something that indeed you'd be interested in doing. Now, the other thing is that ETFs are optionable. And because they trade like a stock, there are many opportunities to trade options around ETFs. Now, one other way that an investor can invest in an index is to actually use options on the index. See, you can trade options on the ETFs that we just spoke of, or you can trade options on the indices themselves. Now, why would I trade the options on the index versus on the ETF? Options on the index are significantly different than those of the ETF, and they're different in the fact that they've got a different what's called settlement ticker. And they're also different in the fact that they have a better tax advantage for most investors. Once again, check with your tax accountant for specific tax, tax effects on your account. But there is typically, for many investors, a tax benefit to trading the index option. And the tax, because they're taxed very much like futures contracts, which has typically 60% of the gain is taxed at the long-term capital gains rate and 40% at the short-term capital gains rate. So a lot of investors will go to index options instead of index ETF options because it gives them a better tax advantage. It can be used as an income tool for suitable investors when they understand some of the things around selling what are called calls and selling puts around different indexes. It does allow for leverage as a tool and can allow for customized strategies. On our YouTube channel, we have many more videos around options. And if you want to learn a little bit more about options, please just go ahead and watch some of those videos. We'll put them in the links down below that you can learn a little bit more about options. But options are a way that an investor can access these indexes. So when we look at these different indices, the Dow Jones, the Nasdaq, the S&P, and how we can invest in them, either through mutual funds, ETFs, or indexes, it gives us the ability to truly represent the market's movement. At IIE Financial, what we do is we will build portfolios around indexes, and we utilize the portfolios that an investor makes the most sense for their risk tolerance. So if you want to learn a little bit more about how could I use some of these ETFs and some of these indexes in my portfolio, feel free to reach out. Go visit us online, iiefinancial.com. Go to follow our Twitter page at IIE Financial, or just feel free to call the offices, 832 832-953-4998. That's 832-953-4998. We also have a podcast, Chuck and Ann on Finance. You can find us at the iTunes store and subscribe. We'd love to have you listen to us on a weekly basis. So until next time, everybody, I hope you have an absolutely amazing day. And thanks for joining us here on the IIE Financial Education Series. Remember, IIE Financial, willing the good of another.